Goldman Sachs just quietly published their most comprehensive market outlook in years. Over 100 pages of dense analysis, data, and forward projections. And within hours, headlines exploded everywhere screaming about an impending market crash. Your phone buzzed, your feed flooded. Maybe you even felt that familiar knot in your stomach, that feeling that you're already behind financially, and now the world's most powerful investment bank is basically confirming your worst fears. But here's the thing, those headlines are lying to you. And if you make financial decisions based on what those headlines claim Goldman actually said, you could seriously damage your financial future. I read the entire report so you don't have to. And what I found is so much more nuanced and honestly more useful than anything you've seen covered anywhere else. I've spent years breaking down Wall Street research for regular people, translating the stuff that institutional investors read into language that actually helps you make smarter decisions with your own money. That's what we're doing today. And if you're new to Sara Builds Wealth, go ahead and hit subscribe now, because this is exactly the kind of clarity you'll get here every week. Here's exactly what you're going to get from this video. I'm going to walk you through what Goldman's report genuinely says, the real risks they flagged that almost nobody is talking about, why the headline version could cost you real money, and the single most important insight buried in that report that applies directly to where you are right now. And I'm saving the most counterintuitive piece for the very end, so stick around because it genuinely changes how you should be thinking about your portfolio. Point 1. Goldman's actual prediction is not what you think. Here's the real headline. Goldman Sachs is projecting roughly a 7% return for the S&P 500 in 2026. Not a crash, not a collapse, a positive if modest gain. They actually titled their report with language suggesting U.S. economic resilience. That is not the language of an institution predicting financial Armageddon. So how do they get to that 7% number? They expect corporate earnings and dividends to drive roughly 11% growth. Strong company profits, continued AI infrastructure spending, healthy consumer behavior. But then they subtract about 4 percentage points because they believe stock valuations will gradually compress throughout the year. 11 minus 4 equals 7. Below historical averages, sure, but solidly in positive territory. They also put recession risk at around 25%, meaning they see a 75% chance the economy keeps expanding. That's not a coin flip. That's 3-to-1 odds in favor of continued growth. So why are people screaming crash? Because fear gets clicks and someone decided 7% wasn't a scary enough headline to share. Point 2, the long-term warning that everyone is misreading. Now here's where it gets more interesting and where the legitimate concern actually lives. Goldman separately released a longer-term forecast projecting that the S&P 500 might only return around 3% annually over the next decade. That number is what's fueling all the doom content, but here's what the coverage consistently gets wrong. That 3% figure is specifically for the S&P 500 as currently constructed, driven by two concerns: extremely high valuations and extreme market concentration. Goldman's forecast for global equities was nearly 8% annually. Even their pessimistic U.S. number represents slow growth, not negative returns. Goldman themselves explicitly stated that low expected returns do not equal an imminent crash. The market can stay expensive for years while still grinding upward. The path to normal valuations doesn't require a catastrophic collapse. It can happen gradually as company earnings catch up to elevated prices. Your takeaway here: stop confusing below average returns with your money is about to disappear. Point 3, the valuation story is real, but it has important context. The cyclically adjusted price-to-earnings ratio, the CAPE ratio, is currently sitting around 39 to 40. The historical average is roughly 17. We're more than double the long-term norm. This is only the second time in over 150 years of market history that this measure has exceeded 40. The only previous time was during the dot-com bubble. That comparison understandably freaks people out, but Goldman's analysis explains why it's not a direct comparison. Today's dominant companies are genuinely profitable businesses with massive free cash flow. The dot-com leaders were often burning cash with no real earnings. Additionally, today's companies operate at structurally higher profit margins, and that can legitimately justify higher valuations. The actionable takeaway: high valuations are a headwind for future returns, not a countdown timer to disaster. Trying to time the market based on valuation alone has been a losing strategy for decades. Still with me? Good, because this next part is where most people completely miss what Goldman is actually warning about, and it's sitting right inside the portfolio you probably already own. Point 4, the concentration problem hiding in your index fund. This is the risk Goldman flags most urgently, and it's the one getting the least attention. The top 10 stocks in the S&P 500 currently represent over 40% of the entire index. That is the highest concentration level ever recorded, higher even than the dot-com bubble peak. Think about what that means practically. If you own a standard S&P 500 index fund, 40 cents of every single dollar you've invested sits in just 10 companies. The other 490 companies share the remaining 60 cents. The Magnificent Seven tech giants alone make up roughly 35%. A single company, Nvidia, represents close to 7% of the entire index by itself. Goldman's research shows that historically, extreme concentration like this predicts lower forward returns and higher volatility. It doesn't necessarily cause a crash, but it amplifies whatever happens next in either direction. If AI spending disappoints, or if any single megacap stumbles, the ripple effects cascade through the entire market. Your takeaway: if you think owning an index fund means you're diversified, you need to rethink that assumption. Goldman actually suggests the equal weight version of the S&P 500 may outperform the standard index over the next decade precisely because it removes this concentration risk. Point 5. The three background risks nobody is discussing. Beyond valuations and concentration, Goldman identifies three systemic risks worth knowing about. First, U.S. government debt. The debt-to-GDP ratio keeps climbing with no meaningful reversal projected. This creates rising interest payment obligations, competitive pressure on corporate borrowing, and a longer-term risk that investors eventually demand higher yields on Treasury debt, raising costs across the entire economy. Goldman isn't calling this a crisis, but it's a persistent background pressure that compounds over time. Second, supply chain vulnerability, particularly around China. Goldman notes China controls around 70% of rare earth mining and over 90% of rare earth refining, materials critical for electronics, electric vehicles, and defense technology. This dependency creates real geopolitical fragility. Third, monetary policy uncertainty. Central banks globally are moving in different directions right now. If inflation stays stubborn and limits the Federal Reserve's ability to cut rates during any future slowdown, the assumption that the Fed always rescues markets gets seriously tested. Your takeaway: these aren't reasons to panic sell. They're reasons to make sure your portfolio isn't fragile. Point 6. The real cost of trying to avoid losses. Goldman includes data in this report that I think every millennial investor needs to tattoo on their brain. Since March 2009, staying fully invested in the market produced nearly 17% annual returns. Miss just the 10 best trading days in that entire period? Your returns drop to 12%. Miss the 25 best days? Returns get cut in half. Here's the critical detail: the best market days almost always happen during the most volatile, scary periods. When your gut is screaming to get out is exactly when staying invested matters most. The investors who went to cash during COVID missed some of the strongest recovery days in market history. Goldman's implicit message throughout this entire report is clear. Attempting to time crashes destroys more wealth than the crashes themselves do. The real danger isn't the market going down. It's you making emotional decisions at exactly the wrong moment. Now here's the payoff, the insight that changes everything. Goldman included a chart tracking their own forecasting record going back 5 years. Over that period, the U.S. market nearly doubled. But here's what makes it genuinely humbling. 5 years ago, Goldman's analysts had absolutely no way to predict COVID, the inflation surge, a war in Europe, or the AI revolution that reshaped the entire technology sector. None of those were in any model. Yet investors who simply stayed the course, who maintained diversified holdings and resisted the urge to react to every scary headline, came out extraordinarily well despite all that chaos. The lesson isn't that Goldman is always right. The lesson is that nobody, not Goldman, not the crash predictors, not the permeable influencers, knows what's coming. What Goldman does know, from over a century of market data, is that staying invested in productive companies over long periods builds wealth more reliably than any market timing strategy ever has. The investors who will regret their 2026 decisions are almost certainly the ones currently panic-consuming crash content and making emotional moves based on headlines that fundamentally misrepresent what the actual analysts are saying. So here's your challenge for this week. Look at your current portfolio and ask yourself honestly, do I actually understand what I own, or am I just hoping it works out? Because that's the gap Goldman's report is really asking you to close. Which of these 5 points hit closest to home for you? Have you been sleeping on the concentration problem in your index funds, or have you already been thinking about the long-term return compression issue? Drop your honest answer in the comments below. I read every single one, and it genuinely shapes what I cover next. If this kind of deep dive, cut through the noise analysis is what you've been missing, then subscribing makes complete sense right now. because this is exactly what you'll get every single week. Real information, no sensationalism, just clarity you can actually act on. The market doesn't care about your anxiety. Build a strategy that doesn't require you to predict the future, and you win by default. And if this video helped you see through the headlines, and you liked what you got here, subscribe to Sara Builds Wealth and hit the bell so you never miss the next breakdown. See you in the next one.